and welcome to another episode of the Opus Wealth Style Podcast. My name is Iván Watanabe, here with my partner, Evan Wohl. Evan, how you doing, buddy?
Throat's a little hoarse today because I went to the World Series game. Thank you for convincing me to go, even though they wasn't a good ending, but it was at least a bucket list I got to check off. So thanks for convincing me to go.
Awesome, man. Well, I'm not going to say I'm not all that disappointed as a Red Sox fan.
So let's keep it moving.
We'll leave that aside, but super excited today to have on a good friend of Opus, a good colleague of ours, Joe Biondolillo from Biond Financial, president and founder. Joe, how are you, man?
Very well, gentlemen. Thanks for having me. A little disturbed from last night's loss as well, Iván. So try to go easy on us.
Yeah, don't worry. We can we'll talk about something a little bit more exciting today. So, Joe, you've been a great friend of mine for a while now, and I know that you spend a majority of your time sort of in the high net worth planning space. So we wanted to have you onto the podcast to kind of talk about some of the different strategies to either remove or address estate tax liability, because I know that's a majority of where your practice is spent. So really excited to have you on. We're going to do something a little bit different today. You know, Evan and I are familiar with the strategies, but we may ask some questions as if we're not familiar, so that, you know, to sort of play the audience a little bit. So as we go through the questions, we might kind of rock through it that way. But before we start, Joe, why don't you just tell us a little bit about you, your practice, kind of what you're up to these days?
Sure. So you know, to your point, our practice is we're doing all different types of planning for the clients that we work with. It's not really pigeonholed only into the high net worth space by a byproduct of the people that we work with. That just so happens to be some of the people that we work with. We're 70% of our practice is working with entrepreneurs and business owners. We're helping those clients maximize the value of their business through retaining their key people and making sure that they've got good succession plans and continuity plans in place, and trying to minimize taxes where possible. And 30% of the folks that we're working with are executives and professionals, and we're doing comprehensive planning with them for similar type of objectives, whether it be minimizing taxes, protecting their assets from the things in life they have no control over, market volatility, inflation, taxes, and the like.
Great. So today, you know, I thought what we would start is maybe just talk a little bit about sort of what proper estate planning looks like for high individuals specifically, and sort of where the problem might lie. What is an estate tax? Maybe even start there, and then, you know, walk through a couple of different strategies that you've implemented and that you see available to high net worth individuals.
Absolutely. So I mean, I think the confusion comes into play oftentimes, where people from an estate planning perspective often determine if they should do their estate planning based on the size of their estate. And we would always recommend, first off, we're not attorneys. We're financial advisors, and we work with attorneys through a lot of these strategies, although I spend a lot of my time understanding these strategies so we can effectively communicate them to clients and really help them identify when there's a deficiency and bring in the proper professionals to help them complete them. That being said, everyone should have an estate plan. An estate plan is just what happens to your wishes if in the event that you and your spouse are no longer here or you're no longer here. Now, today's conversation is about high net worth estate planning. And where it becomes a little bit challenging, and I sort of really enjoy this space, is working with clients that either know they have an estate tax obligation and haven't done anything about it, or simply don't realize that they do have an estate planning tax situation. So what is an estate tax situation? What does that look like? Well, currently the Internal Revenue Service the federal government allows you to gift up to $13.61 million in 2024 to whom you want. You can do that either while you're gone, or meaning when you've passed, or while you're alive. And you could do that for yourself and your spouse. So each couple has the ability to gift $27.2 million while they're alive or upon their death. Now, why is this important? Well, for anyone who has an estate, and we're strictly talking today about federal estate taxes, there's a whole slew of different potential tax liabilities and obligations depending on the state that you reside in or where you do business. So we'll talk about just the Fed. On the federal level, anything above that 13.61 per spouse or 27.2 per couple will be taxed at a rate of 40%. So I'm sure you guys have read some of the case studies where you've got really wealthy families, some of them that have had intergenerational wealth, that through improper planning have a lot of their wealth eroded. And ultimately could be by not having a proper estate plan and thereby having large tax liabilities that are due within a short time period after the death of maybe a patriarch or matriarch.
Definitely. And so, right now, somebody passes away, the federal government gives us 9 months to pay the estate tax due, right? So they're going to say everything above that threshold, everything above that that gift amount is going to be subject to that particular tax. And so we have some options on what to do with assets, right? So why don't you kind of walk the audience through those options and, again, some potential solutions on what that may look like.
So we try to simplify the complex in our practice. Things are really complicated enough. And we don't want to use jargon or make people think these things are more complicated than they are. So by simplifying it, I really have a 3-step process to an efficient estate plan for high net worth individuals. And this is for really one of two people. It's for the individual who's already has an estate tax issue, or alternatively, it's for the high net worth or future high net worth individual, meaning somebody who thinks they will have an estate tax issue. And there's really 3 things, guys, that we focus on. Number one, in order to be able to mitigate or at certain instances eliminate that estate tax, the number one thing is we want to discount an asset. What is an asset? Well, in this space, an asset is any asset that you own. It could be your business, which is what a lot of the clients that we have own. It could be real estate. A lot of our clients own substantial amounts of real estate. It could be equities, private investments, any slew of ownership equity that you have in something is an asset. And the first objective is to discount that asset. The second step of that process, and we can kind of go through these in more detail if you'd like, is gift what you can. Okay. And then the third step in that process is to freeze the growth. So discount an asset, gift what you can, freeze the growth. And if we keep it that simple, we can do a lot of good work in the estate planning space with the current exemptions, just utilizing those 3 tools.
And Joe, how should people think about whether they will be in the need or position for estate planning if they're, let's say, 30s, 40s, and they're looking out so far into the future? And why should they start to plan for that well before they hit that mark?
So, Evan, as you know, the world of taxation is sort of a game of Russian roulette, because what our tax issues today might not be tax issues 25 years from now, and that's what really makes everything we do very complex. So what we always advise the clients is, let's make the financial decisions based on what we're dealing with today. So if we know what tax law is today, we can do planning around that. And as long as the end result there works, terrific. To answer the first part of your question, how does someone project where they'll be? Well, it's not always an easy thing to do. The first thing we do is look at what the client's goals are. If a client has a business that they're looking to scale and exit, we might consider what the growth of that business could be, what the value of that business could be in the future. If the client has already exited a business, which is very common for people in their 30s, 40s, and 50s, they might have a very long window of appreciation of assets. So we're gonna look at things like life expectancy and joint life expectancy to try to get some sort of an inflation calculation of what basic growth inflation would look like on those assets based on how they might have those dollars invested with their advisors. The long and short of it is, Evan, there's going to be one main thing. If the purpose of the planning is to mitigate or eliminate federal estate tax, the one thing we're going to really zero in on now is what are the current value of the assets and what do we anticipate these assets growing to?
And why don't we take one at a time of the sort of 3 different strategy options available? So if you can walk the audience through what discounting an asset is and potentially what that might look like, that'd be great.
Absolutely. So when you do a balance sheet and you list all the assets that you have, or you're going to sell your home, you're going to try to get that asset to be worth as much as you possibly could sell the home for, right? Or if you're going to sell your business, you want your business to be sold for the maximum value. Well, the IRS recognizes that for different reasons, that might not be the value as far as how they're going to value that asset. And there's valuation companies out there that we can use that can put values on businesses or real property or even equity portfolios that could make the number less than what you might have an appraised value on if you were going to say sell the asset or refinance the asset. And why is that? Well, I'll give you an example. Let's assume you and I owned a piece of real estate together and we were 50-50 partners on a piece of real estate and that property was worth $1 million. On my balance sheet, I might have that listed as $500,000, right? 50% of that $1 million asset. But truth be told is because there's a lack of marketability and control, because I do not own 100% of it, the IRS will allow you to take discounts on that asset. So we can start to use professional valuation companies and appraisal companies to say, hey, what type of a discount could we put on this asset? Because it's not really worth $500,000. Because if Joe wants to turn that money to cash, but Iván doesn't want to, that could create complexities. Amongst a whole bunch of other reasons of why that asset might not be able to have its true value. So because the IRS allows us to do that, when we're doing estate planning, we can look at the assets that a client has and see, is there a percentage of that asset we can discount it before gifting that asset to maximize the value of the gifting that we're doing for estate planning purposes.
So just to simplify, the objective here is to get the value of whatever we're trying to get out of the estate or into a trust, which we may get into, so that they can gift. There's more room to gift either during life or at death. Did I get that right?
That's exactly right, Evan. So to kind of elongate what you said or put a little bit more context to it. So if the current individual exemption is $13.61 million, that's the most we can give, right, today. So my goal is to get the client to get as much of his $13.61 million, the most juice out of that squeeze, right? So if I own this $1 million asset and I have 50% of it with Iván and my asset value is worth $500,000, one would think that that's $500,000 worth of gifting if I put it into my trust. But because of the lack of marketability and control, I might be able to get a 25 to 30% discount on that asset, which means rather than using $500,000 of my exemption, I might be able to use only $350,000 of my exemption.
Got it. And is there a rule of thumb on what types of assets should or should not be gifted?
So what I like to tell my clients is if we can't gift everything, then the assets we want to choose to gift are the most highly appreciable assets. You want to put an asset in, an ideal estate plan is to put in an asset for a very low value that in the future will have a very high value and get all of that growth outside of your taxable estate. That's the ideal game.
And are you using any type of specific entity with this discounting strategy that makes more sense than others?
You know, I really lead that up to the direction of the attorneys that we work with. But what I could tell you is that there's a whole bunch of different things that could be done that are very creative that allow you to get greater discounts. Things like creating family limited partnerships, or things like, changing the membership interests inside of an entity to be split up between voting and non-voting shares, where the non-voting shares might not have as much value because of their lack of marketability and control. So there's definitely sort of a toolbox of things that you can do depending on how the client is structured, what their current situation looks like, and what the tax code allows you to do.
So pivoting from there, Joe, we're talking about gifting what you can as sort of the second prong strategy. Right now, 2024, we're able to gift $27.2 million. What's the thought process or strategy around gifting what you can?
Sure. So just a couple of things that we should be clear on. The gifting in 2024 is $13.61 million per spouse. That's the actual gift amount.
Yep.
A couple could gift a combined $27.2 million, which does help for planning. But the actual individual is $13.61 million. So gifting what you can, the reality of it is that's the number, right, that you could gift. So what is the objective? The objective is if a client is a high net worth individual, the goal would be to get as much of that 13.61 million per spouse, or shelter as much of that 27.2 for a family as absolutely possible. That's the goal, right? And then why is that the goal? That's the goal because the intention is that asset is going to grow over a period of time. And if we can use that exemption now versus use that exemption later, here's what we know. We know that in 2025, that exemption goes up to 13.99 million per spouse, or almost $28 million. So it's an extra $800,000 that we can gift. And then by 2026, the current tax code sunsets. And it goes back to the original $5 million per spouse, indexed for inflation, $7 million per spouse, which brings it down from, which was 28 million combined in 2025 down to 14 million in 2026. So gift what you can. You want to do that now, because if you don't give that gift by 2025, by 2026, you can lose 50% of what's possible for you to be able to put into those trusts to mitigate those estate taxes.
And I would say it's probably very likely that all of those tax numbers and tax codes will change in the next couple of years. We don't know how or which way, but seems very likely.
There's no doubt. And the good news is you can't, if it ever increased and you had the ability to put more in the future and there's more assets outside of the trust, you don't lose that opportunity. The only thing you do lose is that if it existed today and it no longer exists 2 years from now, you don't get that back, right? So
That's
it really
a great point.
is, you do it when you die or you do it now. Gift what you can. We know it's available. Let's take advantage of what's available to us, and then we can pivot and do different types of strategies if we need to in the future.
Right.
And the sooner you can gift highly appreciating assets, there's just more network, more you're getting out of your estate.
That's the goal.
Yeah.
And again, it applies to people that are above that threshold and below that threshold, because you're imagining that these assets are going to continue to rise in value over time, right?
Yeah, and it's fascinating to me because I see clients that we work with, consistently, that have sold businesses, are preparing to sell businesses, have owned assets for long periods of time that have appreciated tremendously. And unfortunately, these are conversations that not a lot of people are having with them.
Mm-hmm. Absolutely. And the third strategy that you talked about was freeze the growth. So why don't we talk a little bit about sort of freezing the growth, what that looks like, what it actually means, and then how we can use other potential strategies to kind of maximize that.
So once the assets are inside of the trust, once you've gifted them, into this irrevocable trust, all of the growth of that trust is now sheltered from federal estate taxes. Mm-hmm. So if you have 13 million bucks and you gift it to a trust for the benefit of your wife and children, and that $13 million trust grows to a $50 million trust, you've now protected your family from all of the federal estate tax on the inflation of that asset. So all of the growth that happens on an asset in a perfect world, we would prefer that growth to happen inside of the irrevocable trust versus outside of the irrevocable trust, which could create a federal estate tax issue. Now, there's complexities to that, right? Clients have cash flow complexities. They have access and control complexities. And there are a lot of things we can do with a good team to help them get through some of those challenges and have them have the ability to still utilize the assets to the best of their ability, whether it be for income purposes or things of that nature. But the reality of it is freezing that growth, getting it outside of the taxable estate is ultimately the goal, especially if it's a highly appreciable asset.
Yeah. So when we walk through this strategy with attorneys, oftentimes I find that they believe that this is the only solve. But one of the problems that it creates is the capital gains tax that sort of never gets addressed, Joe, right? So can you talk a little bit about what that capital gains tax issue might be and then a potential solve for it?
Yeah, and that's a great point. So by virtue of gifting, we've eliminated one tax, but we've created another, right? Mm-hmm. So as of right now, the federal estate tax, as we mentioned, is 40%. In 2026, that number goes up to 45%. The capital gains tax, let's talk about the capital gains tax and why it exists. When you put an asset into an irrevocable trust, what you lose inside of that trust is the step up in basis. Mm-hmm. And the basis on that asset is the asset value that you've gifted it into the trust. So to keep it simple, if we put $10 million inside of a trust, okay, and that $10 million grew to $100 million 30 years later, okay, if it was inside of your taxable estate and the estate tax law was as it was today, you'd have $87 million that would be taxable, around $87 million at 40%. Okay. If we gift that $10 million into a trust, we no longer have that 40% tax on, let's call it $80 million. But what we've created is a capital gains tax on the gain, because you lose the step up in basis because the trust owns that asset. And by losing the step up in basis, you now have that same gain, that $80 million gain, let's call it. But in lieu of paying a 45% federal estate tax, you're going to pay a capital gains tax. Here's the other caveat to that, Iván, which I think gives a tremendous amount of flexibility in a planning perspective. The capital gains tax is triggered upon sale of the asset. Okay? So that's a very big thing. Like if you owned a business as an example, that business doesn't have to pay that tax. It's a capital gains tax. Upon the exit of the business, there will be a tax liability to that trust. The estate tax is something that's triggered upon death.
Right. Mm-hmm.
And how you started the conversation of having to owe that tax within 9 months, give or take, that doesn't change. So there's not only a tax that's 40% of the amount, 40 to 50% of the amount, but there's the flexibility of you being able to control when that's due, which might give you the ability to create funding from an external source, whether it be financing or lending, right? You've got some flexibility. Mm-hmm. Or you can also structure, which we do for a lot of our clients, properly structured permanent life insurance policies, where those policies are owned inside of the trust to provide the trust with the liquidity to be able to fulfill that obligation. And by the way, the obligation for the insurance policy winds up being substantially less because the tax liability is only 40 to 50% of what it would have been if it was not inside of the trust, which means that you'd have to have a larger amount of insurance to cover the federal estate tax.
Got it. So in essence, you're creating a capital gains tax, but at least you can control when you pay it because you're controlling when you sell the asset, paying at a lower rate, presumably. And also there's a way to utilize either external funding sources or life insurance to take care of that obligation when and if you choose to do that. Is that about right?
Yeah, that's correct. So I guess to surmise, it gives us a dialogue to have with clients that they know that they've got multiple flexibility and options. And we've seen a whole different array of client circumstances where one situation might work better than another. There might be another situation where option A is the best solution, but it's just not feasible because maybe the client can't qualify or it just doesn't work for their estate. So yeah, absolutely. We want to have optionality.
So Joe, as we kind of wrap up the conversation here, are there any things in particular that you want to make sure that the listening audience kind of takes away? Any sort of tidbits or best practices that you think make sense?
So I think the first thing everybody needs to do who considers having assets that will appreciate over time is understanding what the estate tax exemptions are, understanding what your assets that you currently have could appreciate to, and if those will put you in a potential estate, having a taxable estate at a point in time in the future. If you believe that is something that's possible, you want to begin the conversations now, even though those assets might not be at the estate tax limits. There are things that you can do today that could really protect you in the future. And I think it's a conversation that you should have with your advisors to start saying, hey, is this something we should look at? Is this something we should consider? There is a deadline, right? There is a date that we can't change, and anything's possible. We know how the government works. That being said, the current law is the current law. And I think that gives clients a window of opportunity to review these options over the next 12 to 14 months to see if they make sense.
And I think we should add that all of this conversation is regarding federal estate tax. Every state has its own estate tax rules and laws as well that you need to be familiar with.
There's no doubt. And I don't want to get into the individual states, but I will just give a quick example, right? So New York's federal exemption is almost 50, New York's state estate tax exemption is almost 50% of the federal. So meaning 50% less. So you could not have a federal estate tax liability in the state of New York, but you might have a state estate tax liability. Mm-hmm. So again, the biggest thing you can do is converse with the professionals that you have. If you're not getting the answers from them, there's a lot of outlets for you to be able to learn more about what your current situation is, what it could be, and the ways to mitigate or eliminate the estate tax liability.
Great. Well, Joe, listen, we really appreciate the conversation. I know that the audience will find it incredibly valuable. If the audience wanted to find out more about you and your practice, where can they reach you?
Sure. You can go to our website at www.beyondfinancial, BIOND, financial.com. You can drop us an email through the website. You could contact our office and call us through the website.
Wonderful. Well, listen, we really, really appreciate you being on. Thanks for the insights and the conversation. And to you, the listening audience, thanks for tuning in. Please click subscribe below to be notified when we release our next episode.